Assalamu alaikum. Good afternoon. Renaissance Services welcomes all of you to the investors and analysts meeting of the company. On behalf of the company, thank you all for being here. Please switch off your phones to avoid any interruption. If you have any question, please raise your hand and we will reach you with a microphone. And now, Renaissance Services CEO, Mr. Stephen Thomas, will start the meeting. Thank you.
Very good afternoon, everyone. You're very welcome to our annual session. We don't have anything to present. You have seen our annual report, so we are open to questions from the floor. Thank you very much. If we could ask you to, if you are going to ask a question, please wait for one of the microphones so that everyone may hear. Thank you. Would anyone like to open the question?
Thank you for the conference, and congratulations on the good set of numbers. I hope this will continue. Let me start from the Topaz where we stopped. We had the Topaz conference call the other day, and in that conference call we mentioned about the revenue increase, and the outlook which we mentioned was on the rates. A stable outlook was given, and but we had a mentioning that we would be looking at close to around $500 million in terms of revenue. I just wanted to know, could you please elaborate on, how are we planning to achieve it? The order backlog which we have is around 400 million. And where are we going to see this additional 20% or 100 million coming from? Given the fact that we are already at 86% utilization and the rates are not going to change, so how are we going to achieve this 20% additional revenue?
Thank you very much for that question. I will remark that the 500 million was your own calculation, so we haven't given a direct guidance on that, just for the record. But we are expecting to see 20-30% increase over 2018. And so you're right that approximately 80% of our 2019 expectations are already contracted. So for everybody's benefit, we have a $1.7 billion revenue backlog, which by any comparison is the largest in our part of the industry and one of the largest in the entire industry, though we are taking day rate risks. So we're very humbled by that. In terms of how to achieve the delta between the contracted revenue coming into the year and the full year is already, as you highlight, 86% utilization. So there you have your first 6%. So we do expect to continue the trajectory that we have seen during first quarter. We have started with an even higher utilization than we have posted in 2018, which is a mix of very good outcomes on all the elements we have introduced on digitalization and maintenance of our fleet. So our available day times per vessel is actually one of the highest in the industry. That means that we do have one of the lowest off-hire rates in the industry. So that enhances the available days that we can sell for the ships. So recall as well that we have just put 2 new vessels on contract, large vessels in the North Sea, respectively for Reach Subsea and the second for Fanord. All those vessels are did not encumber any income in 2018, so they are new for 2019. So it's a mix of slightly better utilization, more vessels on hire, and generally just an expectation that the non-contracted revenue, we still have a part of our fleet that will always be what we call spot trading, will have the same trajectory of 2018. So the sum of all those parts will guide us towards an increase of 20-30% over 2018 as we see it.
And just to add on what Rene mentioned, 2018 numbers include only portion of Tengiz revenue. That is our biggest contract. The full play will happen in 2019, and that itself will add significant revenue to Topaz top line.
Correct, Vishal, because the Tengis, we had revenue of 350 million in 2018, and contract backlog is what we are talking about, like the 400 million, and on top of that, how are you going to achieve? That was the question. I totally respect that the Tengis is going to have a full year impact of 180 million, out of which only partially that was booked in 2018. That's very highly contributing to the EBITDA and the bottom line as well. The second question, maybe Steve can take it on the Renaissance Village, Dukam. Can you throw some color on that? We have what's the utilization levels or the capacity occupancy levels that we are running currently, and what are we looking at for 2019 and 20?
Thank you, Joby. I was actually going to thank you for having directed the first question at Rene, but now you have directed the second one at me. Renaissance Village Dukam, we've indicated in the chairman's statement that's gone out, we said we expected to pass break even in the first quarter. We're very pleased to tell you that happened in January, so from the very first month. So that prediction was correct. You know the maths from last year was with build-up of occupancy. You see in the report we lost 2.6 million reals. But so this is the first full year of profitable operations. The occupancy is rising very steadily in accordance with our plans. We finished December at 31%, January 35%, February 41%. Today, the occupancy is just north of 8,700, which is 47%. And that's 47% on the larger number of rooms because the board had approved a conversion and expansion project for our initial expansion, which took the total number of rooms from 16,960, which has been what we've been talking about consistently, is now 18,635. In terms of the prognosis going forward, the demand is clear. So of those 18,650 rooms, 17,730 are sellable rooms to customers. We expect to hit that level in the final quarter just based on demand. Going forward, there is visible demand that could be double that number. And therefore, we are currently proactively looking at proposals to take to the board to consider further expansion, some of which would be permanent, some of which might be modular to deal with temporary peaks. But the good news is that the demand seems to be total. We have 100% of the 3 EPC contractors for Dukam Refinery are signed up. 100% of the permanent major players in Dukam, so the Port of Dukam, Oman Dry Dock, the airport people, there are other contractors like Boskalis for the port, are all with us. So the reputation is strong, the customer satisfaction with the experience, the fact that it is proving cost effective for their projects to stay with us, and at the same time Dukam and Oman is showing the world that you can look after blue-collar workforces in a manner which brings them decency and dignity and a lifestyle beyond just staying in a very limited services camp. So it really is a good news story. You've all borne with us during the 2 years build-up, and so the good news is coming, and it's all very good so far in the year. Thank you.
So just for the sake of clarification, we have our current capacity is 18,600 or 16,900?
Yes, no, the capacity's gone up to 18,635, of which 17,730 are sellable beds. The rest are for our own people, because we put our own people in the same level of accommodation. So it's gone up from what used to be 15,300 sellable beds, has gone up to 17,000. And that we plan to expand further, but we don't have, we're just in the planning phase of that further expansion. Yeah.
Thank you. And just for the modeling purpose, what are the average rate that we are expecting from Tucum and the EBITDA margins? If we can throw some light on the profit margin as well.
Okay, so starting with the sort of rates, the vast majority, so of those 17,000 beds, some 14,000 are going to be in the category of $10, $12, and $14 a night. The smaller number for the senior side will range from $25 up to $64 a night at the senior exec level. But I think you can take that core $12 a night per individual as the core rate. It's not the average, but it's the core product that we sell. In terms of EBITDA margin, I would say,
40%.
no, I'm just thinking what guidance to give that's not a forward-looking thing. But yes, we work on a 40% EBITDA margin, and that may well change to the positive with expansion as well, because as we expand, it's not the fixed cost is not the same of the central facilities that we have.
Thank you. And on the PAC facilities, you have mentioned that there is a likelihood of decline in occupancy levels. Can you please explain why is that happening? Is it because of any reduced level of activities in the PAC facilities or the oil fields?
No, this is a question of the level of activity in the oil fields. In the PDO oil and gas concession area, we've seen these wonderful projects at Harweel and Kauta, which has brought larger numbers in the last year. We were getting up into 91% average. Those projects have come to an end, so the operational phase of those projects are smaller numbers in the field. And, you know, the prognosis going forward, you know, if you look at what PDO is planning over the next 5 years, there's no mega project like a Harweel or a Kauta happening, but there's lots of smaller projects that will have a cumulative effect for us. So in 2019, we're saying, you know, 87%, there was also between 84 and 90% will be the range that we expect to see. What is also possible in the course of this year is PDO and others in the oil field looking at an expansion of the number of, given the success of the PACs, given the success of that model in terms of how well to look after people but still keep it affordable. We may see some growth coming, although that would be about competing for that opportunity, and then we'd probably see the benefit of that in a year to 18 months after competition. But in this year, we're estimating high 80s rather than low 90s of occupancy. It's just a function of activity in the oil fields.
All right. Thank you. And Mr. Vishal, regarding, we discussed this last year as well, regarding the refinancing of your perpetual notes. Is there anything that we can discuss, or are we looking at refinancing it, or are we looking at, what are the options that we have, or are we going for an interest reset?
Thanks, Joyce. Our perpetual notes holders are primarily Omani banks and Omani investors. And we have seen that they have hardly exchanged hands. So they have full confidence in Renaissance business model, and they stayed with us, and the call date is 2020 August. We have full plan and commitment to refi or buy back those perpetual notes. We are working on that. Various strategies are happening, and that is also linked to our Topaz capital enhancement plan, where we have disclosed in the chairman's report that we are working on various options. And once we have very close to some options which look real and good to Renaissance, we will come and disclose to you. So from that also, we can sort out perpetual notes. So we are working on that, how to address it. Step up of interest rate is really not an option, correct? Before that, we need to close that out, because that's not going to work. So we have a plan, and hopefully with Topaz capital enhancement plan, that will be taken care of.
Thank you. And the next question is naturally on the Topaz capital structure plan. Is there any definite timeline that we are looking at, or should we look at it, and can we look at it, expect it in 2019, or will it get extended to 2020? And what are the options? Are we looking at an IPO, and is it only for the minority shareholder, only an exit for the minority shareholder, or the majority shareholder also will be getting some benefit out of it?
Sure, Joy. So basically, one thing is very clear, that Topaz is the survivor. Topaz, if you take top 10 companies in the OSV sector, Topaz stands with the largest order book and really came out strongly. So as a shareholder of Topaz and together as a management, we need to do something about the company, and we disclosed our intentions in our earlier chairman's statement. So we are working on that. Now, equity market for oil and gas facing company is not working. At this point, it is closed because of the volatility of oil prices. Our advisors are advising that, yeah, somewhere Q3 2019, you can look at again that IPO window. But then we are just not dependent on IPO window. When you started the journey, many players came, they got interested in this story because they see that this is the survivor. And we are a couple of interesting ideas are there. And once we have clear visibility, yeah, this is doable, this is good for the company, we will come and disclose to you.
Thank you very much. Thank you, gentlemen. All the best.
Regarding the financing, maybe you mentioned, I don't know, not the extra bets you are going to make in Duqm. Is it going to be self-financing, or is it going to be outside?
In terms of the expansion we've done already, we went back to the existing shareholders of Renaissance Duqm Accommodation Holdings for Duqm, and they provided the equity, and then we borrowed the balance. So we took 40% equity from the existing shareholders, including ourselves. In terms of the any further expansion that I'm talking about, that we're looking at the moment, we would plan to come back to the same shareholders with an equity debt position that we believe would be right for the structure of the company going forward.
And also to add on what Steve is saying, that in 2018, when we operated only for part of the year, we generated an EBITDA of 3.9 million riyal. So that is a good money we have generated. And the way Duqm is going to play out this year, almost full occupancy by the year end, it will generate a lot of cash. We are expecting 9 to 10 million riyal EBITDA this year, and then full occupancy 14, 15 million riyal next year. So we already started speaking to our banks. We are seeing keen interest. So one is the cash flow generated from the business that will play as an equity. Of course, we will go back to our shareholders, but the performance of Duqm will really give confidence, and some part of the equity will come from the business itself.
Yani that what means that when you will pass some of the profit to the shareholders, the nearest time?
This really comes more to the whole question of dividend across the group, not just in terms of dividend from Duqm. So the dividend from Duqm will come into the group, and then it's about when do we get back to a dividend position with our shareholders in Renaissance. Now, we are as sad as anybody when you look at the last 4 years since the oil price crisis, that our record of regular and consistent dividend payment has slowed to zero. So we are very keen to get back to paying regular and consistent dividends at the first opportunity that it arises. And we see a number of positive things that can get us back to that position. One is the level of EBITDA generation we're getting in both companies. The other is what's already been touched upon, some form of capital event, liquidity event in Topaz that would get us back to a position as a group, not just from the contributions of Dukem, but generally that we'd hope at the first opportunity to get back to paying dividends.
You don't have an estimation, yeah, exactly. And after 2 years, after 1 year, after 3 years?
No, it's difficult to give a forward-looking statement of that kind. I mean, we have a very clear dividend policy, which is that we return cash to shareholders whenever there is sufficient liquidity in the company for the safe operation of the company, and that's really why we've been holding tight in the last few years to make sure we came through able to meet all of our financial obligations in all the companies, and I think we've succeeded in that, and we thank our shareholders for being patient with us while we do that. The other is if we have opportunities to invest money for future growth, which we've also been doing even during this downturn, not only with what Topaz has been doing in building up the Cengiz fleet, but what we've been doing in terms of creating the Renaissance Village Dukem during this period. So I don't want to give a date on it, but I would say at the earliest possible opportunity, we want to get back to paying dividends.
Okay, regarding the Dukem Village, what is the percentage return rate on the investment, yearly investment?
So Dukem has started. 2018 was part of operations, and then 2019 is going to be occupancy is building up. We are expecting the return on investment on Dukem project will be more than 15%. It should be somewhere between 15 to 20%.
Yearly?
On an annual basis,
Yeah.
yes.
Yeah. So in the end, if you remember when we put out our information memorandum on this, we expected exactly that range, 15 to 19% IRR. Of course, we've got the drag of the first 2 years. If we take the first 2 years, you have to take away the 6 million losses from those first 2 years. But we get into our first profitable year this year, and when we're at full steam, generating on the current capacity north of 30 million reals per annum. EBITDA is 40%, bottom line is 20%. So there's, you can work it out from there. And within the next few years, we should have caught up with our original 15% IRR and be surpassing that.
Okay, thank you very much.
Hi, thank you. Thank you for both Renaissance and Topaz team. I have a couple of questions for Rene, because I missed the Topaz con call. Rene, I just want to understand, because now Cengiz project is on, you know the value of Cengiz contract on Q4, and you have already seen another quarter, Q1. And we just want to understand how this is panning out as a project, and because we are talking about substantial revenue in the 3 years, and after that there is an uncertainty. And how do you see this progress? And though the numbers are looking good on the initial factor, how do you see the contract panning out? That is one question for me. And the second question is on the two new vessels which is coming up. I think I saw that both the contracts have been signed up, and which is good. I think we want to just understand how this will contribute to the numbers for the current year. And the last one, I think one more on the contract which you have signed for the renewal contract for Azerbaijan. How are the terms? I think, do you think, because you got, at least you got this extension for 5 + 2 years at this scenario, this really proves out to be a strong case. And how do you see that as compared to the previous contract, how was the new contractual terms? Thank you.
Thank you so much. Good questions, as usual. So let me start on the TCO question. We started the campaign last year, and we delivered 27 modules. So coming from a brand brand new design, a brand new architecture, an innovative idea, and then actually sailing these ships and delivering 27 modules, whereas some of them was actually heavier than initially expected in Korea, was very humbling for me to see that we could actually achieve that. So we had a 100% hit rate last year. All the vessels were in action, and our feedback from the client is that on this almost $50 billion total project for Chevron and their partners, we are the one element that is on or ahead of schedule. So that's fantastic from this little Middle Eastern company's perspective. So we are very pleased with that. As opposed to this year, as I've reported before, then this is a seasonal environment. So it's not a seasonal contract, which is a very important point. We are generating revenues 365 days a year. However, the rivers are seasonal, and they're just coming off the ice period and opening up, and we are fully ready to take on the operation for this year. Now, I cannot speculate openly in whether or not all the modules are going to be delivered within the specified 1,092 firm days, but there are built-in extensions to the contract. We believe that there is ample of work beyond the current firm contract to contemplate further seasons. But beyond that, I believe that when we have now proved the concept, no more speculation whether we can deliver a better service than any of the current asset owners can deliver up there in terms of tugs and barges. We have half the transit time. We have fundamentally changed the dynamics around safe passage on rivers. I believe that a lot of these ships will have their future lives in these rivers. If you look at the basin as a whole in Caspian, then you have a huge amount of hydrocarbons in Kazakhstan. You have a huge amount of hydrocarbons in Turkmenistan that is only just being developed. You have a huge amount of hydrocarbons in Azerbaijan, as we all know, and of course Russia themselves. So if you have a safe passage that have now been delivered by this, and you have a lot of oil and gas equipment that you know fundamentally is both out of gauge and very difficult and always urgent equipment, then you also understand that these vessels will probably be the preferred choice in the future. That being said, beyond the Caspian Sea, we have had interest from as far away as the Pacific, from another oil major, actually an oil major part of this project, that we are now looking at for exactly the same vessels. We have had interest for some of the rivers in this area. We have interest from the renewable energy space. So if you look at the vessel, you can see that they are actually large enough and agile enough to have the wings from the windmills, which makes them highly versatile assets. So I'm very comfortable that we have created not only a new market, but we have also an asset available to us that will benefit the company for many, many years to come. There was a lot of doubt, not in my mind, but there was a lot of doubt from the industry, as it will be when you come with a new technology. But now we have proven that the concept were adequate, beyond adequate for this contract. So in terms of the two subsea vessels, we built counter-cyclically two large subsea vessels as a replacement strategy in 2015. They were ordered at around half the price that was indicated in 2014. So we thought this was a great counter-cyclical move. As the industry that Stephen mentioned just before just kept crawling down into a black hole, then we extended the delivery for 12 months together with the shipyard, and we took delivery this year. We were clear that we were going to have formidable counterparties to operate on these vessels. We signed two contracts quite close after each other. One with Reed Subsea, which is one of the formidable bespoke subsea operators in Norway, and another one with Van Oord of Holland. Both vessels are now operating, They have had their first duties, and they have come back with exceedingly positive comments. So we believe that both contracts will be long in years. One is already a multi-year contract with profit-sharing mechanisms. The other one is a year contract with extensions. Those are being taken as we speak. So we are very confident that these vessels will continue, and they are part of the revenue enhancement that I mentioned to Joyce just before, that we see them actually contributing very positively. Now, the trick is that we didn't want to lock them in too long, because we would like to see the rate going up. But this was the right contracts to take now, because as you can understand, a vessel like that needs to create a name for themselves, just as we've done with the TCO vessels. And that name for themselves is being created right now. So that's very positive. So I would not exclude that once the right time is there in the future, we would even look at expanding that case. But right now, Topaz have no unencumbered CapEx plans. We do not have any CapEx outstanding that we have to account for. That's an important point, because that means that we can be aggressive. On your final point, it is something that we have worked on for a long time. And as you recall, in 2012, we fundamentally changed the contracting model of the company to a more conservative, counter how the industry was actually working, and to a certain extent is still working. We wanted contracts. We were going to trade off some cash flows for longevity and security and sustainability of those cash flows. That has played out positive for our company during this crisis. And so the BP 2025 was really a further assurance of our relationship in specifically Azerbaijan. It was a situation where BP was coming out of a crisis and at the same time was looking at how can we ensure the stability and sustainability of this business that is supporting the production and development side of BP in Azerbaijan. So we delivered around about a 5% additional discount through extending this project. This is about $350 million of extra backlog that we have introduced to the company in one of the worst possible crises. So we are very pleased with that. It is a highly satisfactory result, and BP is very pleased. Now, what does that tell you? That tells you that we, as a counterparty risk for BP, is rated top-notch. So I'm not trying to say that frivolously or arrogantly, but for me, it's a very positive outcome of having over and over again, every single day, delivered a service of international standards in a very, very difficult market environment. So we are discussing right now how to expand that footprint with BP in some of our service-related offerings that we have reported that we are building on. So that's BP 2025. It came at a very, very good time, and it was a relationship with BP that just manifestedly tells you that we are doing many of the right things that the oil majors would like us to do.
Thank you. One additional thing, because you also mentioned there has been some reduction in the pricing. Do you mean whatever, in terms of your cost, you have been continuously rationalizing your expenses over the last 2 years? Do you see that further taping out in 2019 also? Any guidance on what kind of the total cost rationalization, so that you will compensate on your whatever your contracting model, because there the margins can be still maintained? This is one additional point I want to understand.
That's a very good question. So what did we also do in the crisis? And this is not limited to Azerbaijan. This is throughout our whole fleet. I was mentioning that we have one of the highest technical uptimes in the industry. So what have we actually done, courtesy also of a strong support from our shareholders, is that we have invested in what we thought was future-proofing our business. So where everybody else fell over a cliff and cut everything, we certainly cut, and we have said goodbye to many esteemed colleagues and closed down offices and so on, because that's what you do in a situation like this. But we also invested in a completely revamped communication system based on Orange platform. We invested in a fleet-wide system to manage all our ships. And we equipped all our seafarers to be able to manage their business just like you do in your office based on Office 365. Now, why is that important? We moved a lot of the decision making on board the vessels. Why? Because we have very well educated officers. So a lot of the overheads that we had on shore are now moved on board to our esteemed colleagues on the ships. We in real time can manage our maintenance and repair planning with the vessels directly. And so we see maintenance costs having gone down drastically over the last 3 or 4 years, but also we maintain that trajectory. And that's an important point. So that's why I'm quite comfortable that when we, on a massive 12-boat contract like the BP 2025, are delivering this to our client, I'm very comfortable that not only can we continue to maintain our cost elements as they are right now, but I actually believe that we will enhance them simply by furthering our digitalization of our fleet. And you will see more and more of that. As a matter of fact, we have signed a relationship with General Electric of America to look at how we deploy at a completely different pace Internet of Things on our ships. So you will see a lot from us in driving that industry like that. CapEx has already been spent. So I don't foresee any material CapEx spend over the next couple of years on this. And if there will be material CapEx spend, not only will we report it, but they will also come with revenue generating items. We don't have material CapEx spend on the cost side, but we certainly expect to soon start to optimize also our revenue side based on having digitized our ships. But that's a separate conversation.
Hi, gentlemen. Thanks for the time. I have a question on your margin side, because you are making almost a 60% EBITDA margin. Sorry, to Rene, at your Caspian operations. At the same time, the industry average is in the range of 10 to 15%. So why your client is giving such a high margin, or what's the chance that another competitor coming to your market, because it seems very high in this market?
Unfortunately, there's no secret formula, but specifically the Caspian market is a landlocked environment. So once you are committed to that environment, you're committed for a long time. And there should be a return on investment for making that commitment. So we committed years ago, and shareholders supported with a lot of investments in that environment. So secondly, it's a stable environment insofar as the cost is concerned. We have 97% localization in Azerbaijan alone. On all the MCV vessels, we have 100% localization. That means that in terms of cost predictability is very, very high. We have taken a long view on our financing, even though that hasn't really anything to do with our margins. But the whole business in the Caspian is based from a stable platform, and we have early on invested a lot in there, and therefore we can maintain very, very high margins. That is known to the oil major, and that is also why they understand that it has demanded a lot of investment, a lot of stability in the market. And of course, we also take a higher risk in terms of moving assets into a landlocked environment. Therefore, we should sponsor higher margins.
Okay, thank you.
I'll take one more. I think this is for Vishal. I think, Vishal, we have been talking about deleveraging for at least a couple of years now. I think still, if you look at the numbers, I think we are trying in terms of the balance sheet deleveraging. It's still a long way to go. And we just want to understand what is the way forward, because since we have been looking at all these TCO contracts and all but cash flow perspective, there are concerns, and which is where we are heading on this. The Topaz capital raising is definitely going to be a different point where you have say. But other than that, Topaz, whatever, you have any way of deleveraging the company?
Thanks, Kanga. And this is very important point because total debt in the balance sheet is $1 billion. That's what you can see, $383 million, Real Omani and $1 billion. This is our topmost priority. So when we look at debt in isolation, it looks really high. But then we look at the growth in EBITDA, what we have achieved this year from 64 million Real Omani in 2017 to almost 100 million Real Omani in 2018, then it's okay. And considering that Dukkam was not a major contributor or almost zero contributor to EBITDA in 2018, and it's going to be a major force in 2019. So you have debt on one investment, but EBITDA generation is coming. So we are not concerned about the absolute number of debt, provided you generate sufficient cash to meet that. So that is one point, because we are meeting all our banking covenants, etc., even at this juncture. So that is one side. But at the same time, we feel that if we need to emerge stronger, create more shareholder value, we need to reduce our debt level. And that is linked to cash generating from new investments like Tengiz, Dukkam, and you know how we have done our Tengiz investment model. We have not put any debt or any money we have raised in our balance sheet. We have used a great structure with our client. Client liked our managing capabilities, and they provided vessels. So those are unique structure we are going to do in the future to create cash flow for us and not borrowing. And once our Dukkam starts generating a lot of cash, that will give us cash to deleverage as well. But the major factor is going to come from the Topaz capital enhancement plan. And why is that? Because if we just see between Topaz and Renaissance, now Topaz has $800 million of debt. Yeah, and Renaissance has $200 million. And in Renaissance, $100 million is for Dukkam. So if you take it out, Topaz and Dukkam, then Renaissance remaining business with PDO Pack and our contracting business with order book of more than 100 million Real Omani, I think we are not a geared company if you see in that sense. So Topaz Capital Enhancement Program is our priority because that can take care of what Joyce mentioned about perpetual notes. That will take care of the gearing and really need to focus on your business and generate the cash which we were waiting for. And I think now time has come. We already started seeing from 2018 EBITDA improvement, and 2019 will further help us. So absolute number, we are not worried about it, but we need to take care of this so we emerge stronger. And really people don't look at us that over leveraged company, exactly your point, and we are working on that.
Topaz has a shareholder loan which is due this year, something like around 40 million owed. So what that was recently restructured. So is there any will that be repaid to the shareholder Renaissance?
So why that shareholder loan was given to support Topaz over last 3-4 years, because we have seen the kind of the crisis OSV sector or oil and gas industry has gone through. The way Topaz cash flows are going to improve just based on the EBITDA generation, this is not a major amount, and Renaissance is not desperate to really take that money, so it will come naturally to us. And if capital enhancement program happens, then it will be taken care once for all immediately. So we are okay, and we will continue to support Topaz. As soon as their cash flow improves, which already started improving, they will pay us. But if we really conclude any capital enhancement program, that will pay us back immediately the money.
And another question is on the ship which is up for sale. You have a $11 million dollar ship which is up for sale. Are there any further ship sales coming up, or this is only one which we are planning for this year?
We every year we are doing fleet renewal checkups. This particular ship is a Topaz installer that has worked with us for many years. She's labeled for sale as part of our fleet renewal strategy. She's almost 20 years old and has served us really, really well. That's the only vessel that is up for sale. Last year we sold 5 ships. This was part of cleaning up some of the vessels that has been in layup and actually protecting our balance sheet. So we did not want to spend more money on the vessels that was laid up. So we scrapped them or sold them for scrap. And that was the right, sensible thing to do. The vessel that we have up for sale today is that is the only vessel that we are contemplating selling.
Thank you. And Steve, can you throw some light on the FMS side? We were talking about PAC, Dukham, but now a major revenue generating factor is the facilities management. How is it panning out? And you have been talking about some consolidation or some expansion plans. And probably Tengiz also is getting into that loop, or maybe you are adding that Tengiz projects service revenue might be coming from Tengiz. So can you throw some light on that?
Certainly, Joyce. If you look at our sort of 2 heavy investment sides and the Renaissance services side of the business, you have Renaissance Village Dukham and you have the PACs. In terms of the facilities management side, we've traditionally come from a strong soft facilities management side, so our catering, cleaning, laundry side. We've been strengthening our hard FM, so our maintenance, mechanical, electrical, etc. Services side. We've opened up, and we've said to you before, our strategy is to diversify, strengthen our capabilities in integrated facilities management. So what we do for the likes of BP in the Kazan field, what we do for running all these facilities management services in Al Mouj and that type of project, strengthening our capabilities in the hard FM side so that we've got a very complete suite of services. And then we said we'd grow the business beyond investment in our accommodation solutions, so Renaissance Village Dukham and the PDO villages and the PACs as you know them, by diversifying our services sectors and geographies. So the services that we've diversified in facilities management, not to be confused with the Cengiz side, what happens there, which is a pure topaz play, a unique contract. But taking from that sort of changing the market and bringing new solutions to our clients. And we've had our first breakthrough this year into the waste management side with the award of the beer projects for CZAD and Al Worcester. That project mobilizes in late 2019, in September 2019. What we've done in moving into the utilities sector and so on. So these are all areas in the pure services side, facilities management side, that are enabling us to grow. The nature of what's happened in that whole industry, not just in Oman, but globally, is that you almost have to keep growing to flat line. And so if we just stayed in our original set of facilities management services, we wouldn't be able to grow the business as we would wish. So that's why we've been investing in this diversification of our capabilities. And whilst they're green shoots, there are some real breakthroughs in what we've done on the military side, on the utilities side, on what you will now see this year on the waste management side, all of which is complementary to the range of services that we already provide in our soft and hard FM. And 2 other important points in how we're approaching it. One is, when we do integrated facilities management, the traditional role that a Serco or a Carillion would play is they would sit on top of everything that the client wishes to outsource that's non-core to them, and then they would outsource to companies like us for the soft services or for the hard services. We have a unique model in the industry where we're capable of delivering that IFM, but because we provide such a broad range of the soft FM and hard FM services, you get a complete self-performance model that doesn't add margins on margins. and that's driving costs down for our customers. And the other is to look at what we can do in terms of the digitalization of our business, the automation of our business, what we can do with IoT and AI to increase the quality of the service we provide, as well as drive down costs, not just for ourselves, but for our clients as well, and pass that on. So there's an awful lot of work. It doesn't get the headlines that a Renaissance Village Dukum or a Cengiz project would get, because it doesn't have that volume. But we're really beginning to see the benefit of that. And we've also been investing in the course of the last couple of years in our management team, in the range of skill sets and capabilities to drive that strategy forward throughout this period. So whilst we've been in a downturn of the market, we've been looking to the future throughout it. And our facilities management side will be a very important part of what we do. And the great thing about it is mostly there's very little investment. Sometimes there'll be 2.1 million reals investment in the waste management, but normally it's fairly small capital investment for a pure services play that adds to the level of returns that we're able to show from our other major investment side. I think in the absence of any more hands going up, we can take it that you're happy that you've asked all the questions that you wish to ask. As always, thank you very much for taking the time and your interest in our company. It is nice to be coming here after some tough years in terms of market conditions with a good story from 2018. And driven by not just Cengiz, but all the great things that are happening in Topaz, and driven by not just Dukum, but all the great things that are happening in Renaissance. I think we can look forward to a good session next time we meet as well, with all things going in the right direction. Thank you all very much indeed.